Welcome back to the deep dive. Today we're embarking on a journey into a topic that, well, it captures a lot of imaginations but really demands serious dedication: day trading. We're diving into a pretty comprehensive guide from a seasoned professional, aiming to cut through some of the common myths and give you the essential insights you really need to understand this world.
Exactly. Our mission today is to give you a clear, practical roadmap to help you understand what day trading really entails. We'll cover, everything from the basic requirements, how to pick your market, crafting robust strategies, and maybe most critically, the indispensable mindset needed for success. We really want you to grasp the core concepts, not just memorize a checklist, so you can make truly informed decisions down the line.
Okay, so let's kick things off. Let's address a question I think many of you might be asking. How does day trading really stack up against, say, more traditional paths,
Right.
like starting your own company or maybe investing in real estate? The guide offers a really stark comparison here. I mean, think about launching a business. You're juggling product development, marketing, sales, delivery, payments. It's a lot. Even online, the author reminds us that Murphy's Law is always lurking, right? Whatever can go wrong probably will. And dealing with people, that just introduces endless variables. Then you have physical businesses adding even more complexity. Employees, vendors, office space. It's just this demanding, often 24/7 commitment. Sometimes it pushes owners right back to a 9-to-5 job.
Yeah, it's intense.
And real estate, that comes with its own set of hurdles too. Market slowdowns, credit crunches, high down payments, often 10-20% for investment property.
Yeah, that capital lockup is significant.
Totally. Then there are the transaction costs, realtor commissions, maybe 3-6%, closing costs running into the thousands. A single deal can drag on for weeks, even months. And that's before you even think about potential headaches with renters, contractors, or, legal stuff.
That's a powerful contrast, isn't it? The guide highlights that in day trading, you're looking at almost instantaneous returns, potentially. Trades can convert to cash in seconds. You can do multiple buy and sell actions within minutes, really. And the transaction costs are remarkably low, often under $10 per trade.
Which is, yeah, a huge difference compared to real estate.
Exactly, thousands in closing costs there. But, and this is a crucial insight, despite these apparent advantages, the author is crystal clear. Day trading is not some dream where you just do nothing and collect huge checks.
Right. Not a magic money machine.
Definitely not. Which immediately raises the vital question.
Yeah.
Okay, if it's not a get-rich-quick scheme, then what is it? The guide firmly states day trading is a business. Simple as that. One that demands significant time, discipline, effort, and commitment. Success simply won't happen overnight. It's an incredibly competitive field. You need a solid trading strategy. And, just as importantly, the unwavering discipline to stick to it. Think of it like any other serious profession, really. You learn the basics, you apply them, you gain experience, and then you continuously refine your approach. The learning literally never stops. I mean, you wouldn't trust a surgeon whose only training came from free internet videos, right?
No, definitely not.
So why expect to make millions in trading with, minimal effort? It just doesn't track.
That sets the stage perfectly. So, okay, you're committed to the journey. You understand it's a serious business. What does that actually look like in terms of, well, cold, hard cash and the essential gear? Let's unpack that practical toolkit you'll need. How much capital is really required and what equipment is absolutely non-negotiable. The initial capital you need, it's actually surprisingly varied. Depends heavily on your chosen market. For instance, if you're day trading stocks in the US, there's the pattern day trading rule. That's a huge hurdle. It mandates at least $25,000 in your account if you make 4 or more day trades within 5 business days.
$25,000. That's a significant barrier to entry for many.
It really is. For futures, it's typically more like $5,000 to $10,000, though some brokers might let you start with maybe $2,000. Options often fall in the $1,000 to $5,000 range. And for Forex, believe it or not, you could potentially start with as little as $500.
But that capital amount isn't just a financial hurdle, is it? It's a big psychological one, too. Can you actually handle seeing a substantial chunk of your capital tied up or potentially lost without letting your emotions completely dictate your next move? This really underscores the author's crucial advice. Never borrow money to trade. Never. And never use money you genuinely can't afford to lose. You have to be really honest with yourself about your risk tolerance. A $1,000 loss feels completely different if it's 50% of a $2,000 account versus, say, 1% of a $100,000 account. This emotional component is just vital.
Absolutely. And the tech side, what's the basic setup?
Okay, technologically, the foundation is pretty straightforward, but it's essential. You absolutely need a computer with a second screen, minimum. One screen for your charting software, that's where you get your crucial entry and exit signals, and another for your trading platform, where you actually place the orders. A 17 or 19-inch monitor is recommended, just for clarity. You don't want to be squinting at tiny numbers.
Right, makes sense.
And a reliable internet connection. Non-negotiable. We're talking DSL or cable. Definitely not dial-up, if that's even still a thing. Even small data delays can seriously impact your decisions, especially in fast-moving markets. Charting software is indispensable too. It displays real-time market info. Look for user-friendly platforms, ones that let you backtest strategies, maybe program custom indicators. The guide mentions examples like eSignal, TradeStation, Metastock, Genesis Trade Navigator. Key advice: always take advantage of free trials and money-back guarantees. Prioritize ease of use over just finding the lowest price.
Q-tip.
And of course, you absolutely need a broker. It's important to understand the difference, right? Full-service brokers might offer advice, but usually charge higher commissions. Discount brokers just execute your orders. The guide puts it well. Your broker is essentially your only team member. So don't just chase the cheapest commission. Try to find a trustworthy personal broker if you can, someone with a direct line you can rely on. And funding your account properly means finding that sweet spot. Not so much capital that losses feel like peanuts and you get reckless.
Right, play money syndrome.
Exactly. But definitely not too little, where every tiny market wiggle triggers absolute panic.
Okay, so capital sorted, tools in place. The next huge question emerges. How do you decide which market is the right arena for your day trading journey? This is where it gets really strategic. The guide lays out 4 key criteria for evaluating your options. First, capital requirements, which we just touched on.
Yeah.
Second, leverage. That's your ability to control a large amount of money with relatively small capital. Third, liquidity. That means quick, accurate order fills, and it helps you avoid market manipulation. And finally, volatility. That's the potential for profit from price movements because, if a market doesn't move, you can't make money, right?
Exactly. And it's fascinating how each market really balances these 4 factors differently. Let's maybe quickly explore the main types available for day trading, keeping those criteria in mind.
Sounds good. Let's start with stocks.
Okay, stocks. As you mentioned, in the U.S. particularly, the $25,000 plus minimum for pattern day traders is a big one. Leverage. Typically 1.1 for cash accounts, maybe up to 1.2 or even 1.8 on margin. A major risk highlighted in the guide here is pump and dump schemes. We've all heard stories, right? Where promoters artificially inflate a stock, hype it up.
Get everyone else to buy in.
Right, then they sell when prices rise, leaving later investors holding the bag with big losses. The guide even mentions a specific example, MOSH, from back in December 2007. It just underscores the need for really careful due diligence in stocks.
Definitely. Okay, what about Forex?
Forex, or FX. This involves trading currency pairs, your AUD, USD/JPY, that kind of thing. You can potentially start with much less capital, maybe $500 to $1,000. Leverage here is notoriously high, often 1.10, sometimes even 1.20. This market is incredibly liquid. We're talking trillions traded daily. It dwarfs other markets. Volatility is decent, typically 0.5% to 1.5% daily moves. But here's a key point. You pay a spread. For example, maybe 2 pips. A pip is a tiny unit in currency trading, a fraction of a cent usually. But with that high leverage, even 2 pips can translate to roughly $20 per trade cost because it's not traded on a central exchange like stocks. You're essentially paying the dealer's markup.
Right, that spread is your cost of trading. Okay, futures.
Futures. These are contracts for future delivery of commodities, things like currencies, interest rates, energies, food, metals, agricultural products. They actually have a long history, originated way back in 18th century Japan with rice trading. The initial margin for futures is relatively small compared to the contract value itself. For instance, an E-mini S&P contract might need around $2,000 to $4,000 margin to control a movement worth $50 per point. So futures offer high leverage, easily 150 or more, and decent volatility. The regulated markets and commissions are typically low, often below $5 per transaction. And crucially, you're not going to have a truckload of corn dumped on your lawn.
Good to know.
Your broker handles rolling over the contracts. Profits and losses are settled daily right into your margin account.
Okay, makes sense. And lastly, stock options.
Stock options. These give you the right, but not the obligation, to buy or sell an asset at a specific price by a specific date. Like stocks, they often fall under that $25,000 pattern day trading rule. They offer potentially very high leverage. For example, buying 100 IBM shares might cost, say, over $11,000. But a call option giving you control over those same shares might only cost $330. That's roughly 130 leverage. However, liquidity can often be low. There's just such a broad choice of strike prices and expiration dates for any given stock, and volatility can be scary high. An IBM option might see nearly 20% movement intraday. Plus, their value isn't just supply and demand. It's determined by complex mathematical formulas, like the famous Black-Scholes model, factoring in time decay, volatility, and other things.
Wow, okay. So that's a lot of different playing fields. What does this mean for the approach you actually take to trading within these markets? The guide outlines two fundamental styles. The first is fundamental analysis. This looks at the cause of market movement. It studies underlying factors, economic growth rates, interest rates, inflation, company-specific data, earnings reports, things like that. For example, the guide points out how Fed interest rate cuts back in '07 and '08 had almost opposite effects on the Dow Jones Index, or how high oil prices could mean an economic slowdown, or it could mean inflation is heating up. Predicting the market reaction based on fundamentals is, well, tricky.
Very tricky. And that leads us directly to the other main approach, technical analysis. This operates on a fundamentally different philosophy. Technical analysts believe market action discounts everything, meaning essentially all relevant information, fundamentals, news, sentiment is already reflected in the current price. So they focus purely on price data, which is seen as more objective. They believe prices move in identifiable trends and that historical trading patterns tend to repeat. Why? Because human psychology driven by greed and fear remains pretty constant over time. This approach is generally considered, let's say, easier and faster to learn for day traders. It's more about interpreting those human reactions reflected in price charts rather than trying to forecast complex global economic shifts.
Right. So if you are leaning towards technical analysis, then charts become absolutely critical. Your best friends, really. As the author puts it, a picture speaks 1,000 words. And in day trading, charting is exactly that, the graphical expression of a market's behavior over time. And it boils down to 4 daily trading points for any period. The opening price, O, the closing price, C, the absolute high price, H, and the absolute low price, L. These 4 points are the foundation.
They are. And 2 common ways to visualize them are bar charts and candlestick charts. Bar charts are very common. A single vertical bar stretches from the high to the low of the trading period. Then there's a little horizontal tick or foot on the left side marking the open and one on the right marking the close. They clearly show the direction is the close higher or lower than the open and the overall range for that period.
Pretty straightforward. And candlesticks.
Candlestick charts. These are actually not new at all. They've been used for hundreds of years by Japanese rice traders. Developed by a trader named Homa way back in the 1700s. He famously noticed that human psychology seemed to influence rice prices just as much as supply and demand. So these charts offer maybe a richer insight into that psychology. They don't just show direction, but also the momentum behind the move. They have a body that's the wider vertical part between the open and close price, and then wicks or shadows, which are the thin lines extending up to the high and down to the low. Usually if the close is above the open, the body is one color, maybe green, showing an upward move. If the close is below the open, it's another color, often red, for a downward move. They give you a quick visual sense of the battle between buyers and sellers.
Okay, so you've got these charts. How do you actually use these visual tools to spot opportunities? One of the most basic but crucial skills for technical traders is drawing and interpreting trend lines.
Absolutely fundamental. Trend lines help you identify the market's underlying direction. Is it generally going up or generally going down? In an uptrend, prices are making a series of higher highs and higher lows. You draw the trend line connecting the lows underneath the price bars. In a downtrend, prices are making lower lows and lower highs. You draw the trend line connecting the highs above the price bars.
Seems simple enough, but are there rules?
There are. The guide gives 2 critical rules for drawing them effectively. First, never adjust a trend line just to make it steeper. It can only become flatter as new price points form. And second, keep the trend line relatively close to the price action connecting the significant lower lows in an uptrend or the higher highs in a downtrend. Don't draw it too far away, or you risk missing an actual change in the trend when price breaks through it. Understanding whether our market is clearly trending or just chopping sideways in a range is really key. It dictates whether you should be looking for trend-following strategies or perhaps range trading strategies.
Right, different tools for different market conditions. Now, let's shift to something absolutely critical, yet often tragically neglected. How and when to get out of a trade. The guide really hammers these points home, and for very good reason. First up, the stop loss.
Cannot emphasize this enough.
The author's message is just unequivocal. Always use stop losses. Always. A stop loss is your safety net. It limits your potential loss if a trade goes against you. It's that predetermined price level where you say, okay, my reason for entering this trade is no longer valid. I'm cutting my losses here. If you don't use them. Well, that $300 loss you thought you were risking can easily balloon into a $5,000 loss. Or worse, it can wipe out your trading balance entirely.
It happens faster than people think.
The guide even shares this really compelling, kind of scary anecdote. A trader made a nice profit, stepped away from his computer, but forgot to cancel his protective stop-loss order. The market retraced, hit his stop price, which was a sell order, and boom, it filled, putting him into a short position right as the market started rising again. Wiped out all his profits and then some.
Ouch. A painful lesson.
Exactly. The moral is crystal clear. Always cancel your working orders once your trade is closed, either at a profit or a loss. Or, even better, use things like bracket orders or one cancel other OCO orders. Your broker can definitely explain those. They basically link your profit target and stop loss together. Stops can be set in different ways too, right? Like a fixed dollar amount, say $100 loss per trade, or a percentage of the current price, like 1%, or maybe based on volatility, or using technical levels like support and resistance. That's right. And this brings that human psychology element right back into sharp focus. If limiting losses with a stop loss is crucial, what about the other side taking profits? The author makes this really sharp distinction. Good traders use a stop loss. Great traders use a profit target. It speaks to overcoming greed, doesn't it? Our natural human tendency, especially in trading, is that desire to get rich quick on just one massive winning trade. But the guide argues the key to long-term success is actually counterintuitive. It's about small profits consistently. Nail that down first. If you can consistently bank small, reliable profits, then you can gradually use leverage or increase your position size over time.
Build it up brick by brick, essentially.
Precisely. And profit targets, much like stop losses, can be defined in several ways. A fixed dollar amount is often the easiest to manage emotionally. Yeah. Or maybe a percentage of the current price that's more practical for different stocks, right? Yeah. 1% of IBM at $110 is very different from 1% of Ford at $7. You could also base it on a percentage of market volatility, which works well for things like commodities that can swing wildly. Or again, use technical analysis, major support resistance levels, pivot points, trend channels can all provide logical exit points.
Okay, so stop loss protects your downside. Profit target locks in gains. Is there anything else we're getting out?
Yes, there's another critical exit strategy mentioned, the time stop. This is important. If your trade just isn't doing anything, it's not hitting your profit target, but it's not hitting your stop loss either after a certain period, you should consider just getting out. A rule of thumb might be, say, 3 times the time frame of the chart you're using. So if you're on a 15-minute chart, maybe exit after 45 minutes if nothing significant has happened. The reasoning is, if the market isn't confirming your initial trade ID relatively quickly, maybe your assumption was wrong. Just staying in, hoping something happens, well, that's drifting closer to gambling than disciplined trading. It preserves capital and, frankly, mental energy.
That makes a lot of sense. Preserve capital, preserve focus. Okay, so you've defined your market, got your tools, figured out your entry, and, crucially, your exit rules. The big next step is, how do you actually know if your trading strategy works before you risk real money? The guide presents some vital methods for evaluating your strategy. Let's talk about testing.
Yeah, this is where the rubber meets the road before you actually hit the road. The first method is backtesting. This basically involves running your strategy's rules against historical market data. You simulate how it would have performed in the past. It's hugely valuable because it can save you a ton of time and potentially money compared to just trading it live and hoping for the best. It operates on the theory, or at least the hope, that what has happened in the past will happen again in the future.
Oh.
But there's a big caveat, right? The results are highly dependent on the specific historical period you test. A system might look amazing tested over a strong trending period.
But fall apart in choppy, sideways markets.
Exactly. So you need a test across different market conditions if possible. And that leads right into this vital distinction the author makes between optimizing a strategy and dangerously curve-fitting it. He strongly warns against endlessly fine-tuning your system after only a few live trades, especially if it was originally backtested on hundreds or thousands of historical trades. The danger is curve-fitting, basically, over-optimizing your rules so they perfectly match past data. It looks fantastic on paper.
Too good to be true, maybe.
Often, yes. The problem is, a system that's curve-fitted too tightly to history often fails spectacularly when real live market conditions inevitably shift. It hasn't learned robust principles, just memorized the past. The advice is, if the underlying logic of your system is sound, it shouldn't need constant tweaking. If performance falters, the first question shouldn't be how do I tweak the parameters, but rather, does the core logic still apply to current market conditions? For example, a trend-following strategy just isn't going to work well if the market is stuck in a range.
So backtesting is one tool. What else?
Another technique mentioned for testing robustness is the Monte Carlo simulation. This is a bit more advanced, maybe. It's a problem-solving technique used in many fields. In trading, it can involve running multiple simulations of your back-tested trades, but randomizing the order in which they occur. This helps assess things like the probability of experiencing a certain maximum drawdown, a losing streak, or the likelihood of achieving a certain rate of return. It gives you a better sense of the range of possible outcomes, not just one historical path.
How long do you need to test for?
Well, it depends heavily on how frequently your strategy generates trades. If it's, say, 3 trades per day, you might get statistically relevant results after maybe 3 weeks of testing or live simulation. But if your strategy only triggers, say, 3 trades per month, you really should test it backtest or paper trade for at least a year to get reliable data. Markets change, remember. And when you're testing, keep a detailed performance report. Track everything. A truly robust system, the guide suggests, typically shows certain characteristics. Maybe a winning percentage around 60–80%, a profit factor, meaning total profits divided by total losses, somewhere between 1.3 and 2.5. And crucially, a maximum drawdown, the biggest dip from a peak in your equity curve that's maybe only 10–20% of the projected yearly profit. These kinds of metrics help you identify potentially curve-fitted systems versus genuinely solid ones.
Okay, so testing is key. This seems to tie back into common mistakes traders make.
Absolutely. It all connects. The guide highlights the big ones. Not taking profits when the plan says to, usually due to greed, not limiting losses by ignoring or not even using stop losses, letting small losses become account killers, and overtrading. This is a big one. It can be driven by greed after a nice win, feeling invincible, or by revenge trading after a loss, trying to win it back immediately. And let me tell you, the market is always stronger than your desire for revenge.
So what are the hallmarks of successful traders then, according to the guide?
It paints a clear picture. Successful traders. They don't blame the market or anyone else. They take responsibility and action. They use systems that are statistically sound, high probability, good money management, and definitely not curve-fitted. They recognize that a good trade isn't defined by whether it made money or lost money, but by whether they followed their plan meticulously. They also understand the importance of taking time off, stepping away from the screens to maintain perspective. And crucially, they don't fear losses. They accept them as a normal, unavoidable cost of doing business in a probabilistic environment. It's not a personal failure, it's just part of the process.
That concept of risk and controlling it is really central. The guide uses a driving analogy, which I thought was quite good. Can you walk us through that?
Yeah, it's simple but really profound. The idea is, risk essentially means not having control. Think about driving a car. How do you control that inherent risk? Through education, you get your driver's license, learn the rules of the road. Through safety features, seat belts, airbags, steering wheel, brakes. And through practice, you probably started in an empty parking lot before hitting the highway at rush hour, right? In trading, this translates directly. Education means constant learning, understanding the markets, understanding your strategy. Safety features are your tools, your platform, your charts, and especially your stop losses and position sizing rules. Practice means backtesting, simulation, and starting small. The guide explicitly states that the right psychological mindset is one of the keys to investment success, and most traders fail to understand this. It's not about being fearless. It's about being prepared, disciplined, and in control of your actions, even when the market feels chaotic.
That's a powerful connection. So what does this all boil down to for you, the listener, as you consider or maybe even start on your trading journey? The pathway to reducing that risk, to gaining confidence, really seems to lie in continuous, but importantly, risk-free learning at the start. The guide highly recommends using a paper trading account, also known as a simulator or demo account.
Absolutely essential first step.
It allows you to practice your strategy with virtual money. You get live market quotes, you can enter trades, manage positions, see your profit and loss update in real time, but without any actual financial risk whatsoever. It's just a fundamental step for gaining experience, building that crucial discipline, testing your rules, and getting comfortable with your platform before you put any real hard-earned money on the line.
Well, we've certainly navigated the complex, definitely demanding, but yes, potentially rewarding world of day trading today. We've uncovered the need for a disciplined approach, the essential technological tools, and maybe most importantly, that crucial mindset that seems to set successful traders apart from those who fall into the common traps.
Yeah, and if we connect this to the bigger picture, it really highlights that day trading is so much more than just, trying to predict where the market will go next. It's really about developing a robust, tested plan, sticking to that plan with unwavering discipline, managing your emotions, and committing to constantly learning and adapting. I think the true aha moment here lies in understanding that risk isn't just about random chance, it's about control. Control you gain through knowledge, through deliberate practice, and through that emotional regulation we talked about.
So after this deep dive, what really stands out to you? Maybe it's that clear distinction between fundamental and technical analysis we discussed, or the absolute non-negotiable necessity of using a stop loss. Perhaps it's the power of aiming for small, consistent profits rather than chasing that one huge win. Remember that opening quote the author used from Richard Salwerman? Facts in themselves don't solve the problem. Facts are only meaningful as they relate to a concept you can grasp. So the final thought for you to mull over is, how can you apply this deeper understanding, grasping the concepts, not just the facts, to become a more informed, more disciplined learner? Not just in trading, but maybe ready to tackle any complex topic that sparks your interest.